What's going on, YouTube Nation? This is Darth Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So we are at 4,800 Dividend Warriors strong in this YouTube channel. I made a big risk. I started my niche in nursing, kind of like fitness, nursing, and I had about 3,000 subscribers, and I decided to change my philosophy. I really fell in love with dividend investing and I really changed my channel around. So a lot of you guys that stuck around that are nurses or big in the fitness industry that love dividend investing, thank you guys. I know I did lose a lot of subscribers. People weren't happy with me changing my niche. Maybe I'll make a new channel on that in the future. But I got a bonus stock for you guys too. It's not a cheap dividend stock, but it's a really good dividend growth stock. It's one that I used to own. I sold, made a big profit on, and I bought it into other stocks. So these stocks are under $20. I own some of them. One of them I'm considering buying. These are very popular dividend stocks that people praise. I really love the compound interest kicking in. These guys have consistently increased their dividend over time. Some of them are under the radar. So I'm very excited to show you guys some of these stocks. So let's check them out right now. The first stock I would like to bring up is Physicians Realty Trust. I own that in my M1 Finance dividend portfolio. So this is a healthcare real estate investment trust. It is a little bit in the high yield dividend side. So I was really attracted to this stock, and I'm going to show you why shortly. But I'm going to be honest with you, healthcare, it's only going to get bigger and bigger. The demand for healthcare is going to be higher because people are getting sicker, and the statistics prove it as well. So, people are coming in the hospital with comorbidities. There's a rise in diabetes. There's a rise in hypertension. There's a rise in cardiovascular issues. There's a rise in hyperlipidemia. That's the norm. People really don't want to fix themselves. That's unfortunately, there's a rise in mental health, which correlates with poor health outcomes with people who are depressed. They really don't want to make changes on their their health. So their hemoglobin A1Cs with insulin. Hemoglobin A1C is a test that they do every 90 days, and that's a true test to see how you're doing combating your insulin. So if you have an A1C above usually 6.5, that's a problem. That increases your chances of a stroke, infections, cardiovascular issues. Just diabetes is not good, and it's just growing and growing. And there's just a lot of issues right now in healthcare, and the demand's going to be a lot higher. So let's check out this healthcare rate portfolio before we start jumping into the dividend history. So here's the map on Physicians Realty Trust. This is again a healthcare rate. So you want to see what type of buildings that they own, and are they strong? Are they stable? I'm going to already tell you yes, and I'm going to show you why. So here's just some places that they own. So these are single tenants that are paying rent. And again, this is a specialized real estate investment trust. So these are multi-tenant buildings, single tenant buildings. There's going to be a demand, okay? There's a multi-tenant building, Doctors United, ASC. So medical plazas, health clinic and specialty centers, physician centers. So people are going to need to pay rent. And, here's just healthcare buildings after healthcare buildings. Here's St. Vincent. So you see what they're specialized in, okay? Medical centers, they are places that people need and pay rent. Hospital systems, here's a pediatric specialty center. So physicians need to rent offices. People need to come in there. I know that people do virtual visits with their physicians, but what happens if you catch something that's off, when people visit their doctor? So you need to physically go there and see your doctor. So look at this, Springwood's Mob. And again, here's 8 City Boulevard. These are beautiful buildings. The market cap is $3.94 billion. The volume is high, and it's $18.29. Again, here's just Ohio, Riverview Medical Center. So here's Westerville Mob, New Albany Medical Center, and that's actually a popular place, and I was considering taking a travel position and as a travel nurse over here. So here's just some examples of what they have. South Point Medical Center, I'm very familiar with that. Some of my friends have worked over there. Zangmeister Cancer Center, that's a very popular center. So Cincinnati Eye Institute. So you're seeing where people are paying rent for buildings like this. These are multi-tenants, single tenants. People have to pay rent. So they can't pay rent or leave. Guess what? They'll get a replacement. So now you're seeing the portfolio of this, and I'm just doing the state of Ohio. So that's an example. And they're just going to expand and get bigger and bigger and acquire new buildings, and people are going to pay rent. There's a demand for healthcare. So that's the reason why I bought it. So let's jump to its dividend history. We got 22 cents, 23 cents. Right at 23 cents. PE ratio is 59. That is a little high, but I feel pretty confident in the stock. Dividend yield 4.98%, annual dividend of 92 cents. Ex-dividend date, the declaration date is 6/8/2021. The date is 7/1/2021. I'll check my M1 Finance portfolio to see if I got some money from this real estate investment trust. So this is a quarterly dividend, $18.29, a 4.98% dividend yield. That's pretty attractive. And again, the occupancy rate, last I checked, it was in the high 90s, right around 98%. So if a pandemic or recession happens, people are still going to need to see their doctors. So that's one thing. I feel that the healthcare rates are very stable and strong. I believe that, they are recession proof because people need to see their physicians and things happen. And don't forget, like that one building that I had with the Eye Institute, glaucoma is off the chain too. So you got to be careful with a lot of these diseases. The specialists are in demand, and it's going to get higher and higher. So let's check on the next stock. Arbor Realty Trust is the only M rate that I trust and believe in. I am long in this stock, just like Doc, and I'm just going to reinvest the dividends. But look at this. In the past 5 years, how can you say M rate is actually beating the S&P in the past 5 years? And it's been very consistent. And it's not jumping up too fast either. But this should be a wake-up call that this stock is increasing its price per share. It's doing very well, and it's in demand. And people have a lot of confidence in this M rate. So these mortgage-backed rates, usually things like agnc, they have decreased their dividend over time. They're a scary yield trap. But Arbor Realty Trust, if they're going up, something's going right with this stock. So they're very well managed. They have a very good reputation. The symbol is ABR. I did numerous reviews in these guys. $17.77. Let me jump to its dividend history. This is what I like about this. I cannot believe that this is like a very popular one. Now, I have a covered call ETN that's mortgage-backed rates. I'm okay with that because it's kind of like a scatter bomb with distributing dividends. It's not going to jump up. It's not going to jump down. You don't know what you're going to get each month with the mortgage-backed rates, but you're going to get money with the covered call ETN. So you're guaranteed something. If you, sometimes you can get 10 cents, sometimes you can get, 25 cents. You just don't know, how it's a very, very volatile covered call ETN, but, I'm going to be a little aggressive, take a risk and go from there. But, this is one that I just bought. I bought more. I'm long in. And it's crazy how it is so much better than AGNC. So any of you guys that own AGNC stock, you guys are out of your mind, and you should buy this one. And I'm going to show you its dividend history. Okay, this is the difference between them and AGNC. I'm going to have to post stock analysis and dividend analysis on AGNC as well right now, because you guys, you know what? I'll do it in a video later today after I post this one, because you guys need to wake up and realize that AGNC is not a good stock to buy. Again, none of this is financial advice. You can do what you want with AGNC stock, but Arbor Realty Trust runs circles around it. I'm going to show you the dividend history of ABR stock. So you have a high yield dividend stock that is increasing its dividend and is beating the S&P in the past 5 years. That's almost impossible. That's like a unicorn stock. Okay. This is like a stock that you can have in your Roth IRA or traditional IRA and feel confident in it because it's going to increase its dividend and it's going to increase its price per share. It's not going to go too fast, but you're getting a nice dividend. Look at this, 27, 28, 29, 30, 34 cents, 7.63% dividend yield, $17.77. Annual dividend of $1.36. PE ratio 7.19. Okay, you can say this and that, but it's increasing its dividend. It's increasing its price per share. That's why I'm long in it. And I'm going to continue to buy more. I mean, I'd be crazy not to buy this at a low price. So that's why I have it in my E-Trade dividend portfolio. So I'm going to jump to the last stock right now. What do I tell people all the time? Take it to the bank. Huntington Bank Shares Incorporated, HBAN is the symbol, $14.35. There's some negative press that came on that they underperformed, and they're $14.35. I can almost guarantee you that when I switch up my M1 Finance portfolio to have a little bit of the financial sector, these guys are going to be in it. Why? Because they're cheap. 2, banks make money. Banks are going to make money anyways. Anytime you swipe your credit card, they make money. Even if you pay off your interest, people sometimes, owe credit card loans. People aren't very responsible with paying their loans off. These guys loan out money. They are, I'll show you a little bit of their revenue. They have increased their dividend. They actually did well against the S&P in the past 5 years, which is very impressive for the financial sector. And guess what? They're still down. They're not beating the S&P. So that makes it even more attractive to buy. I mean, would you rather buy a stock like Starbucks when it's way up or when there's a dip like this? You're going to want to buy, somebody like Starbucks. Look at this, $6.83. I bought Huntington Bank shares and then I sold it for a profit. Look at how low that is, $6.83. Imagine if you threw $200 worth in that and just reinvested the dividends. That's a steal. So anytime a pandemic happens or a recession, the REITs, the real estate investment trust, and the financial sector, those guys take a huge hit. So that's when you buy the dip. You should have some money. I always call it strike money, $1,000, $2,000 ready in case the market takes a big dip. And you just, boom, you have that cash ready and boom, you capitalize on it. And this is what happens. So let's jump a little bit to the financial information about Huntington Bank shares. So here's some information real quick I just want to show you. So as I say, take it to the bank. This is on NASDAQ.com. Even after a long history of paying dividends, the company's distributions have been remarkably stable. Since 2011, the dividend has gone from 4 cents to 60 cents. This works out to be a compounded annual growth rate of approximately 31% a year over that time. It is good to see that there's been a strong dividend growth and that there hasn't been any cuts for a long time. So that's one thing that's very attractive. This was made on June 4th, 2021. Financially, we need to see how much they make. And they're a big company, by the way. And again, if you're a bank, you have to be stupid to go out of business. Either you get bought off or you just do something extremely stupid, because Wells Fargo made some mistakes and they're rebounding right now. So banks usually improve pretty quick and they adapt. The recession was a big issue with banks and they kind of woke up from that. So, banks are always going to make money. So that's the one thing that's very important. Let's just jump to see how much revenue they made. So here's just some information. I own KeyBank, by the way. It's $6.4 billion. Huntington Bank shares made $4.815 billion. So that's pretty attractive. So that's one thing that's very attractive is a bank. Now let's look at the revenue trends, though. So again, it looks like a 5.39% decline year over year in March 31st, 2021. And the revenue for 12 months ending March 31st, 2021 was a 7.8% decline. Big deal. I'm not too worried about seeing this because, again, you're seeing an increase, and then a little bit of a decline. Big deal. I'm not too worried because, a pandemic happened. And again, it's slowly going to recover. These banks are going to slowly recover. It's not going to happen overnight. So I'm not too worried about this. With this decline a year over year, banks are going to make money. Look, like I said, you get a credit card from Huntington Bank shares, you swipe that somewhere, you get a cashback card. Guess what? The company that you like, say like I go to a grocery store and I swipe my Huntington Bank shares card, they have to pay Huntington Bank shares some money just to use their card. I'll give you an example. There's a place, Mark's in Stowe, where I'm originally from, Stowe, Silver Lake area, and now there's one where I live out in Lake County. They only did cash. So it was a big turnoff because everybody started to have credit cards, and they finally adapted and they said, oh, okay, we need to start using credit cards or else people aren't going to come in. So I go to Mark's all the time. It's right by a store that I'm at. It's right by my apartment complex. So why wouldn't I use my credit card? And I get a cash back. I use a cash back card. I'll give you my referral if you're interested in 3% cash back and Capital One. Absolutely love it. So I'll give you my referral link if you're interested. So 3% cash back in groceries. Who says no? And these guys have to pay your bank. So that's the thing. They're going to make money. They're going to make money anyways. Loans, car loans, student loans, it doesn't matter. Banks make money. They know what they're doing. I mean, that's why they make billions of dollars. So let's jump to that bonus stock I was discussing. Now, it's not a cheap dividend stock, but it's a nice dividend growth stock. The board of directors made a call in 2019 to be a dividend stock, and it's actually a competitor of Amazon. Let's check that out. That stock has beaten the S&P as of late. That is eBay. The board of directors made the call that we are going to be a dividend stock. So that's one thing that's very interesting is eBay made the call. Wouldn't that be crazy if other stocks made the call that they're going to be a dividend stock company? But the board made a call to attract dividend investors and have people buy shares of them. So this is very interesting. I did own these guys, and I sold them with a dip to buy other stocks. And this is a very attractive dividend stock. This is a slow growth stock. I think it's very stable. It makes right around $10 billion last I checked. And it's slowly increasing its dividend. It's not going to jump up too fast, but it's a nice conservative stock for you to have as a dividend stock. And I'm going to jump to its dividend history real quick. So you have a PE ratio of 17.01, a dividend growth of 1.03%. Now, this is something where you have to have a lot of money in, and then it'll slowly increase its dividend. The annual dividend is 72 cents. One of the reasons I sold it was I just, I like the 3 to or above percent dividend yield. Obviously, if it's stable like Arbor Realty Trust, I love that 7% dividend yield. But slowly it's going up. So this is one, you have an M1 Finance fractional share portfolio. I'll have my affiliate link in there as well if you're interested in signing up. You get $30. I get $30. It's great to start up with. So I'm just letting you know that's one way to consider buying the stock. Again, none of this is financial advice. This is for entertainment purposes. I have a disclaimer in my comment section. In my description section on all my videos I make. But you got a slow dividend growth. You have to throw this in your traditional or Roth IRA or something. Increases its dividend over time. Very nice growth stock. I know it's in some ETFs for slow dividend stocks and stable ones, but this is a good dividend growth stock. 14 cents, 16, 18, just about every year it's 20 cents. So you're getting a good bang for your buck with this stock. Just one to look at. I know the dividend yield is a little bit lower than my range, but it's one if you're interested and maybe you're a little bit older and thinking about getting consistent stocks that are conservative, slow dividend growth, not slow dividend growth, but dividend growth, and almost, financially it's good, it's a good dividend stock, slow and on the uptrend. You want to increase your net asset value, with your traditional Roth IRA. This is a good one because it's going to slowly go up. Your net worth or your net value will increase because eBay consistently has increased its price per share and has increased its dividend. So if you have a lot of money in it, $10,000, $20,000, you're going to make a good bang for your buck. So that's one thing to look into. So let me know what you think of this video of these 3 cheap dividend stocks in eBay. This is Darth Dividend. You guys have a good 4th of July weekend. I'm going to post a video on the 4th, so don't, stay tuned. And I'm going to try to post one on Monday. So you guys take care, be safe, have a good one, and enjoy the weekend.